Thank you very much for these kind words. A very good afternoon to all of you. I'm the after lunch wake-up call. Let's see how that works. I've been asked to provide you with a short 20-minute or so oil market outlook. And what I will do is I think I will base it more or less on exactly what Carl has just mentioned, this long-term energy outlook which we do, which has a time frame until 2035. But do not worry, I'm not going to spend much time talking about the next 20 years. We just start with the big picture and then narrow it down. I want to focus in particular on two things which are currently characterizing big changes in that oil market. One is the ongoing sort of tension between supply disruptions on the one side and unconventional growth on the other. And the other one is the more medium-term development, but which also has started to affect many producers, in particular national oil companies as well, of the necessary redirection of trade this will bring with us of oil away from the Western Hemisphere, in particular North America, and towards Asia. Big picture first, just one very big picture slide, or maybe one and a half. When we look forward over the next 20 years or so, then we continue to forecast an increase in oil consumption. Oil is for us the slowest growing fossil fuel, grows at about 0.8% per annum, but that still would mean that in our book by 2035 we will have oil consumption and therefore oil production at about 109 million barrels per day. Don't get hung up on the numbers, could be 3, 4, 5 more or less. Slow growth, steady growth, but still an increase of about 20% from today's levels. And this is an attempt to just put the basics in context in terms of demand and supply, and I want to go through it quickly because later on I will just drop the demand side. On the demand side, all of that growth, at least in our book, and I think by now for most analysts, will come from outside the established so-called developed economies of the OECD. Mostly, of course, from Asia, but also with sizable growth in the Middle East on the back of continued subsidies. In our book, at least, Middle East per capita oil consumption 20 years from today will be almost reaching American levels, will be the highest in the world then. Contrast with that, a decline in consumption in the OECD economies. That decline has started in the year 2005, and we think it's a structural feature of oil markets. It is something permanent. And the underlying mechanics are easy, really very simple. When you have oil, in particular in the OECD, largely concentrated in transport, and you have pretty massive efficiency improvement in the vehicle fleet, already enshrined in all sorts of regulation, energy efficiency regulation in the CAFE standards in the US, environmental regulation in the in Europe, then what you get is a situation where the efficiency improvements of new vehicles outpace the number of new vehicles in the OECD, because with very stagnant populations and a high saturation rate, the number of cars isn't growing very fast. And the reverse is true for the so-called developing world. Of course, they also have efficiency improvements, but there, on the back of rising incomes, the number of new cars is predicted to grow so far that it will outpace these efficiency improvements. That is sort of the broad picture on the demand side. Other than that, we see oil continuously losing market share where that is still possible in things like power generation, industrial use, outside transport, and everywhere where it has to compete with other cheaper fuels. I want to put the focus in what follows on the supply side. And again, big picture first, over the next 20 years or so, if we distinguish the two fundamental sources of supply, OPEC and non-OPEC countries, you see that we at least have penciled in larger growth outside the OPEC areas than in OPEC countries. Right? Most of that will come in the form of what we today call unconventional liquids, oil sands, tight oil or shale oil, and a sprinkle of biofuels. And most of that will therefore be concentrated in North America. Compared to that, we also have over the long term OPEC growth concentrated in Iraq and with natural gas liquids, a byproduct of gas production, which is not subject to OPEC quota, and which for these two reasons can be expected to grow quite fast. The problem, of course, is that here we have a timing problem. The increase in North American production and the increase in unconventional liquids, this is something which is happening now. The OPEC increase, we pencil in a little bit later. So let's have a look at exactly what I mean by this increase in unconventional liquids. In particular, let's have a look at tight or shale oil, the thing everybody talks about. On the left-hand side, again, this is the half-big picture, the general outlook for global oil markets since 1990, steady but slower growth. You see the dark green area below. These are the conventional production outside OPEC. These are things like the North Sea, Alaska, offshore Brazil in the future. Moderately declining, but basically steady. On top, the light growth, and then the yellow for the NGLs is OPEC production, growing moderately over the T period. And this fan in the middle, which starts very small and is opening right now to quite sizable levels by 2035. These are these unconventional liquids. Mostly tight oil in the US, also tar sands or oil sands in Canada, and a little bit of biofuels. And what we then try to do is to get a better understanding and a better grip, in particular, on shale oil or tight oil developments. And that's what you see on the right-hand side. The right-hand side just breaks out a production profile which we try to construct based on simply what we think we know about the geology, what we think we understand about infrastructure requirements, and also what we think about the political constraints to access in various regions of the world. In our picture, this means that tight oil goes from literally 0 to about 7% of global oil production by 2035. 7% by 2035, that would be about 8 million barrels per day. Now, there's three interesting characteristics of this production profile which are important when you want to discuss what happens in oil markets in the future. The first one is that right now, where this line is, we are in a phase of rapidly accelerating production growth. It goes up very, very steeply. This will not last. In our picture, production growth of tight oil or shale oil will continue to grow, but growth will slow down appreciably, will decelerate over time. The second observation is that in this production profile, much of what is happening the next 20 years or so is still driven by what is happening in North America, specifically in the US. That includes that first characteristic of decelerating production growth. In fact, what we have is production growth in the US starting moderately, but still to decline in the 2020s. And the third feature of this production profile is that, yes, there will be other countries and regions moving in, applying these technologies, producing shale oil over time, but this will not happen fast enough to reverse this general feature of gently declining production growth, of the deceleration of the growth profile. Now, this, of course, is an area of huge uncertainty, and you can find lots of different forecasts in there. So one of the things we did in order to sort of get a better handle on where we stand with this particular production profile is to compare it with everybody else's forecast, all the forecasts we get a hold on. Turns out we were still relatively on the conservative side. The majority of forecasters would pencil in slightly more aggressive growth globally. So keep that in mind when we talk about the implications, that they are based on a conservative, relatively moderate picture. One thing we should be clear about before getting to the present and what the impact is, that this is not only about the future. This is already big. The growth in the US over the last 2 years, the US has seen the biggest increment in their national oil production since they begin to produce oil. That's since 1859. Biggest production growth ever in the US. And a friend of mine did this funny calculation. He figured out that what happened last year in the US was the 9th biggest increase ever in global oil, in the history of global oil production in any country. All the other 8 happened in Saudi Arabia, and 5 of the other 8 were based on existing spare capacity. So they had cut 1 year and then increased based on spare capacity. So if you talk about organic growth based on capacity expansion, what we have seen last year was already the 4th biggest increment ever anywhere in the history of global oil markets. And when something like this happened, and it's true, we are the first ones to anticipate that, and you're in a position like mine working for a commercial company, then of course the first thing which happens is that the boss will knock on your door and he will want to know, so what does that mean for oil markets? And what he really wants to know, of course, is what does that mean for prices? And here we come to one of these forks in the road where different outcomes are plausible. If the oil market were to be a normal market, this development would already be large enough to bring prices down. And all that's left for the economists to do is to calculate when and by how much. But the oil market is not a normal market because it has a cartel in it, OPEC, which has its own idea about managing production, stabilizing output to stabilize prices. So in the matter of oil markets, this question, what does this North American unconventional growth mean to prices, seamlessly translates into the question, how is OPEC likely to react? And on that question, your guess is probably better than mine, actually. It's not as good as mine. You can have different opinions. We think that on balance, there are compelling arguments to think that OPEC will be willing and capable of cutting its own production growth in response to this supply growth outside of its jurisdiction. If that happens, then what will result is what you see on the left-hand side. That would result in, based on this production profile I showed you, in the generation of spare capacity in OPEC countries to the tune of about 6 million barrels per day within this decade. That would be the highest spare capacity since the 1980s. And you would see that doesn't last very long because demand continues to grow. Demand for OPEC oil is first declining and then later on coming back, and as new production comes on, spare capacity normalizes. This picture and this discussion or this fact has already caused some people now to come out of the woodwork and to start predicting oil prices will go down. We are in for another experience like we had in the 1980s. I don't believe this to be the case. There's very big differences to the 1980s. Number one, in the 1980s, demand was falling, now it's rising. And we would at least think it continues to rise. Number two, it's true the size of what happens now in the US is roughly equivalent to what happened in the late 70s, early 80s in Alaska and the North Sea. But the market is much larger. In 1985, when OPEC's spare capacity reached its maximum, it was equivalent to 17% of global oil production. What we are predicting here today is only equivalent to about 7% of global oil production. And number three, there's another difference to the 80s. In the 1980s, you had these huge projects coming on, mostly North Sea and Alaska, where private producers competing with each other basically faced an almost binary choice, to cut or not to cut, and to eat the costs. And they decided not to cut. With tight oil, the situation is different. Because of the very high well intensity, there should be a much more scalable output. There should be a much more elastic response to falling prices. How that works, we've just experienced with shale gas. When prices dropped under 3, you saw immediate supply response. Right? So it's not a picture like in the 1980s, but it will put, to some degree, will test the cohesion of OPEC. Now, when you hear this and hear me saying this decade, you may sort of think, what is he talking about? Because the actual situation right now looks quite different. Nobody thinks of OPEC cuts at the moment. People think of supply disruptions. Nobody thinks of really too much oil on the market. People think of quite tight supplies. Here's how it looks today. On the left-hand side, we have OECD industry stocks, and the blue line there below the band of the last 5 years, which is penciled in. This is what we think would happen if OPEC production 2014 would be roughly on a par with what we have seen in 2013. OECD stocks, sorry, not OPEC stocks, OECD stocks declining. One of the reasons, which increasingly becomes obvious, is that there's less need to hold inventories because there's less imports into the US. But another reason for this picture have been the supply disruptions which we're seeing. And on the right-hand side is an interesting observation about how nervous actually markets are at the moment about continued supply disruption. The right-hand side depicts the difference between stocks measured in days of forward cover and future prices versus prompt prices. So when you think of future prices anchored in some more long-term expectations, the tighter stocks are, the higher the prompt price, and therefore the market in backwardation. Right? That relationship has been around for a long time, still seems to be holding. But it has shifted. For the same prompt price, the market now needs higher stocks than before, a clear sign of an increase of what we normally call the precautionary demand for oil holdings, of nervousness, of guarding against disruptions. Why is that? We have seen, of course, another feature over the last 3 years, which seems to contradict what I've just said about the potential impact of shale oil. And that is that we had, for more than 3 years now, prices at very high levels and extremely stable. The weekly volatility over the last few months or so was one of the lowest we've ever seen in global oil markets, but on a very high level, while production was very high. So what's going on? And the explanation is, of course, that we had a situation where this production growth in North America has been offset, almost one by supply disruptions. This left-hand side is, at the moment, my favorite graph, and it really is something which requires some attention. If you think back 3 years to the beginning of what now is known as the Arab Spring, the civil war in Libya, since then, we have indeed seen some of the biggest supply disruptions in the history of global oil markets. Most people are not aware of that. Certainly the biggest since the collapse of the Soviet Union more than 20 years ago. If we calculate together the disruptions caused by the war in, the civil war in Syria, the birth pangs of a new country in Sudan and all the interruptions that meant, the civil war in Libya, plus the sanctions against Iran, then we have seen supply disruptions, this is what goes down here, to the tune of about 3.5 million barrels per day over these last 3 years. 3.5 million barrels cumulatively. Now, for comparison, in the 10 years before 2011, the average annual supply disruption was 100,000 barrels per day. That's what I mean by big. And by sheer coincidence, by nothing but sheer coincidence, these disruptions have been matched almost 1-to-1, barrel for barrel, by production increases in the US. The green one are the production increases in the US going up. The other one are the supply disruptions going down. It's a sheer coincidence and amazing. Even the time profile looks the same. So it's absolutely fair to say, and this is what I think many people don't realize, if we only had all the wars and social unrest and political upheaval which we have seen the last 3 years in North Africa and the Middle East, you would have seen prices spiking. Talk about releasing the SPR, talk about damage to the global economy, all the rest of it. Or, if we only had had the production increases in the US, you would have seen prices coming under pressure, talking about the need for OPEC cuts, all the rest of that. What we have seen is this unbelievable mix which resulted in extremely high and extremely stable production, which also resulted, of course, in large OPEC producers producing record volumes at record prices, and prices not moving around very much. Now this, of course, is a problem. It's a problem for me as a forecaster, and it's a problem for you as an industry. Because one of the few things which are clear when you have coincidences like this is that they're unlikely to continue. And so the big question is, what is going to happen? How do we look at this? Is this a transitory event? Are these just 3 years which were different and after that everything goes back to normal? Or should we assume that the world has changed, that something is different, that we'll see more of the same? That matters, right? From my perspective as a forecaster, normally we are not interested in short-term transitory movements. For example, 2009 in the economic crisis, when the whole economy seemed to collapse, we didn't change our long-term growth forecast. What's a little recession among friends? It will be washing away over 20 years. Same question here. Is this short-term, transitory, or is it longer? Ultimately, we came to the conclusion that something has changed and that one has to incorporate in the future slightly more space for these disruptions. There's 2 reasons for this, one in the past and one in the future. The reason in the past has to do with the history of supply disruptions in oil markets. Every single time big disruptions happen, it takes much longer than people think for production to come back. On the right-hand side, you see an example. If you take big events like the revolution in Libya in the 1970s, the revolution in Iran in the 1970s, the collapse of the Soviet Union in the 80s, the Iraqi-Kuwait war in the 1980s, in none of these cases, none of them, did production go back to pre-disruption levels within 10 years? In many of them, it never came back. With the implication, we don't know how the shape is in which fields are in Iran or how much damage there is in Libya, so, but the implication would be that, again, it will take longer than people think if the situation normalizes. This is partially, of course, a technology question, but I think the truth is that every single big supply disruption usually has this impossible conglomerate of technical difficulties, economic mess, political disasters, and so it just takes time. And the other reason for skepticism has to do with the underlying sources of all the social upheaval and political unrest and military unrest which we have seen in North Africa and the Middle East. If you believe that at the core of these problems are also problems of the economy and people's living conditions, yeah? It's not just some political conspiracy, then there's few reasons to be optimistic. And I'll show you why. If you look at, and it has to do with the economic shape major oil producers are in. We didn't want to step on any country's toes, so we looked at OPEC as a bloc, just as a representative bloc for oil producers. If you do that with the eyes of a simple-minded economist, what do you see? Number one, population growth twice as high as in other non-OECD countries. Number two, per capita income in real terms in OPEC countries, believe it or not, flat since 1975, whereas it's increasing by 170% in other non-OECD economies. Number three, energy consumption in OPEC countries, and when I say energy in OPEC, I mean oil and gas, going through the roof. 75% per capita higher than in other non-OECD economies, based on very cheap energy. Why does it matter? Because it means that, of course, OPEC as a bloc will continue to be able to export oil and gas. But there is no way that they continue to have these very high growth rates of exports of oil and gas, which we have seen over the last 30 or 40 years. And that means less revenue growth. And that means less money available to pacify the economy and straighten out people's income at a time when there is economic pressure and when there is a lot of population pressure. And again, don't shoot the messenger, but for the simple economist, that translates into a problem for the future, for social and political stability in the future, as long as you believe that the economy has something to do with it. So we worked in an increased anticipation of disruptions, but even in that scenario, plus our relatively moderate production forecast of tight oil in the US, you still arrive at the need for OPEC cuts this decade, which I showed you at the beginning. And I want to conclude by broadening out this picture. We've talked about supply disruptions already, that's an energy security problem. But there is, of course, another big implication of this production growth in North America, and this is this tremendous reorientation of global trade, which we are witnessing. And that is something which has already started. Within this decade, North America will also become a net exporter of energy. It's already a net exporter of coal, will become one of natural gas and of oil. What you see here is when you divide the world by major regions and continents, those lines which go down, these are importing countries, the lines go up, these are surplus or exporting countries. And you see how North America turns from an importer to an exporter. What does that mean? It means that imports are being concentrated in only two regions. There's only two major regions left for oil imports. One is Asia, of course, and the other is Europe. In Europe, we should expect fairly stagnant growth, if growth at all. Actually, we should expect a little decline. So all of the increase will take place in Asia. We think that by the 2030s, about 80% of all the interregional global oil trade will go into Asia. And the numbers are quite staggering when you just take the two big extreme cases, the US and China. In the US, oil imports peaked in 2005 and accounted for about 65% of domestic consumption. We think this goes down to below 10%. Others think the US will even become an exporter. In China, meanwhile, which used to be an exporter, believe it or not, you see imports rising, and they will rise to about 75% of Chinese consumption over the next 20 years. That means that China will, both in volume and in percentage terms, be more import dependent on oil than the US has ever been. And now step back and just think what this means for major oil-producing regions. It means that the entire Middle Eastern exports will have to be redirected from the Western Hemisphere, from North America, into Asia. And actually, when you do the numbers, surprise, surprise, it means even more. These redirections will not be enough. Asia will have to source additional imports from other regions, such as Africa, such as the former Soviet Union. And now I won't speculate about it, but all you need to do is to step back and think about the political relations involved between the Saudis and the Americans, between Iran and China, between Saudi Arabia and Iran, and you have enough potential for things to go wrong. Long-term forecasts, such as ours, are of course based on the baseline idea that things will turn out to be right, that global trade routes will be kept open, that markets will be kept open, and so that the situation can continue to develop. But no one can guarantee that it's going to be a smooth ride. And I want to stop here, so if I should sum up this position, this time through which we go through, one more word on the trade side actually. You see that starting already. I don't know how many people are here from Africa, but when you go to African exporters, they are already facing this problem of no longer being able to export to the US or Europe and having to export to Asia, i.e. mostly to China, and they are starting to discover what that means if imports become more concentrated and you have only one customer. But if I should sum up the situation currently, of course, peak oil rightly has died its 150th death and is unlikely to come back anytime soon. There's no supply issue here below ground. There is energy security issues of the variety we know about these supply disruptions, which will always be with us, always give gainful employment to people like me. And then upcoming, I'm afraid, with this huge reorientation of trade, there may be geopolitical issues which would be new and which would be more powerful than what we have seen in the past in terms of disturbing the smooth trade of oil on which we all depend. Thank you.
Thank you very much. That was a fascinating presentation, as usual, from Christof. You're available for a few questions. I just wanted to kick off by a question which occurred to me as you were talking, because it has arisen in the conversations we've had already today about the effect in unconventional oil of rising costs and depletion rates. And I was wondering whether what we've been hearing from the Barnett Shale and Eagle Ford about problems arising as a result of rising costs, of infrastructure problems, of skills problems, shortages, and whether depletion rates in shale oil, unconventional oil, are making a difference in the way you're looking at the future.
To the extent that we don't think that growth in the US continues at current rates, as I said, in the 2020s, it's likely even to decline a little bit. But if you step back and you look at why this development happened where it happened, in the US and in Canada mostly, then you wouldn't be worried about these things, because the intuitive answer to that question would be, well, it must be because that's where the resources are. We all know there's a lot of oil sands in Canada, there's a lot of shale rock in the US. But the fact is also that we also know that Venezuela, for example, has more heavy oil than Canada, and nothing, absolutely nothing happened in Venezuela in response to 10 years of rising prices. Our geologists today tell us that China has probably more shale gas resources than the US, and nothing came out in China in response to years and years of high rising prices. And you could carry on this analogy by looking at deep water production offshore Mexico versus offshore the US. It happened in those two countries for a reason, and that reason has a lot to do with open access and with competition. And the shale gas revolution is a classic example. You had very high prices, and you had the shale resources known for a long time. And then what you had was a lot of small and medium-sized companies moving in that space, trying to connect the two. And only after these new technologies had been developed did the big guys, the BPs and Exxons of this world, try to buy the technology and transport it around the world. This was a classical case of competition breeding innovation. Meanwhile, we know how widespread these resources are around the world, even including in the US. There's big resources in California, in upstate New York, which are not even touched, this time for environmental reasons. In other countries, they are not touched because of fear of fracking and political resistance to shale production. When you look at that picture, then you know the potential is so enormous that decline rates in certain locations are likely to be compensated by others. And there is a second point. The US has been the first and is now reaping the classical benefit of a first mover in this kind of game. They are now in a phase where they see tremendous efficiency gains. It's no longer about inventing a new technology, it's about refining this technology. I think in 2012 it was when we have seen the output production and the number of wells in North Dakota going up 40% faster than the rig count, indicating just pure efficiency improvements as people get better at what they do and as learning curves kick in and so. And that effect will be with us for a long time. The history of oil fields and of oil production in general has always been one that there was more in there for longer than people thought initially, and I don't see that changing.
Okay, would anybody like to ask Christof a question? If I can see any hands, this is your opportunity now.
Why do you think the success of shale oil in US cannot be repeated either in Europe, Africa, or Asia?
So, did you understand?
Could you just repeat that?
Yeah, we had a tremendous success of finding shale oil in US. Why is it that the same success story cannot be repeated in other places?
When Europe is a classical case, I don't think there will be the same success in Europe. In fact, we project extremely mellow or almost zero growth in Europe. And the reason is a classical case of what made the success in the US possible was an open market with free access and then competition. What makes it impossible in Europe are these restrictions to access. And you can already see it. I mean, if you look across Europe, you have countries like Poland and the Ukraine basically begging for investment. Then you have countries like France or Bulgaria imposing a moratorium, basically outlawing fracking. And then you have countries like Germany or the UK maneuvering somewhere in the middle and trying to figure out how to deal with this. And the restrictions for access, they're always driven by two. One is resistance against fracking, because of population density, environmental concerns, all the rest of it. And the other is straightforward environmental concerns. The irony is that when you do all the numbers, it's so easy to show how a little tiny replacement of globally of coal with natural gas, including shale gas, would have vastly better implications for CO2 emissions than all the renewables which we have. But that hasn't sunk in with most of the environmental movements right now. So you have access restrictions of a political or of an environmental nature, and I don't see those going away anytime soon.
Thank you.
Question for the gentleman over there.
Anwar Khalaf from Bahrain. The slide you have shown that depicts the production cut versus the production gain, the balance between them is very interesting. But there is a very big difference between those two trenches. The production gain from the shale gas is very expensive to maintain because those wells decline quite rapidly. You have to re-enter the wells, you have to re-stimulate to maintain that production, while the areas where you have lost the production is pretty easy to bring back into the market. I wonder what is the impact of this rather distinct difference between supply and demand trenches there.
I'm not sure, which two countries did you mention at the beginning?
You know, the shale gas, you have a cost to maintain. You have, you know, the shale gas wells will decline by almost 80% in 6 months to 1 year. So there is a cost to maintain that production. The production that you have lost in Iran or in Iraq or in Sudan, this is the easy oil. You switch off the wells, you reopen. You know, these are two different production
Yeah, I agree. These are different things. And essentially, what has to happen in shale oil production or so is that you have to keep running to stand still at a much higher rate. We are seeing, as I said, at the moment, almost unlimited new supplies coming on, and we're seeing these enormous efficiency improvements. At the moment, counterbalancing the high decline rates in the US. Not forever, I agree with you, but it will be a mix of factors which bring that down. And then in fields like big fields, traditional big conventional oil fields, you have an entirely different problem. You have much longer time horizons, you have enhanced oil recovery, and in the case you mentioned, where you had supply disruptions like in Iran, you have the problem that some of the capacity declines. When we see the sanctions kicking in the first time, it was not for nothing that Iran tried very desperately to sustain production levels and to put this oil in inventories and tankers and everywhere they could store it. Eventually, production had to decline, the water cut increased, and that damages fields. Now, this can be rectified, but you need modern technology, you need investment, and it's not clear, at least to my knowledge, to outside observers, how quickly it could be rectified, even in the best case scenario. So, assume sanctions completely lifted, everybody is free to invest there. We don't know how long that would take. What history teaches us, it takes much longer. What I suspect is it also takes longer because it is never reduced to a pure technical question. It always comes hand in hand with changing political, economic, and other circumstances which delay this kind of process. So what you have, if you want to simplify it, in the case of shale production, so is some sort of production level which is constantly threatened by falling down if you don't keep these high investment rates up. And what you have in the case, in your example of Iran, is a situation where the level has skipped down, and the question is how quickly can it, if at all, can it be brought back to the previous volumes? It's a different question, and I don't think there is an easy way of saying one is faster than the other. What we should suspect in the bigger picture is continued growth of tight oil production for the next few years and a risk of continued supply disruption in other parts of the world.
Okay, well, I think that's we're slightly running out of time, Christof.
Okay.
But thank you very much. That was a brilliant presentation,
Thank
as
you.
usual.
Thank you.